All right, Joe, do you want to start and give people a little bit of a lead in on why we're doing some of this, some of the just the changes with regard to GMEDD? Maybe you should probably, for the sake of people who haven't been around, um, I guess for the last 3 or so years, maybe start all the way back at, from your perspective where we started GMEDD, and then I can jump in and get things going.
Back in early 20, what was it, early 2021 was when the report came out. So late 2020, Rod and I were participants in the Roaring Kitty YouTube streams. We'd tune in, what was it, every Wednesday,
Monday,
Tuesday,
Wednesday, Friday.
Monday, Wednesday, Friday. That's what it was. And we would tune in and we'd watch Keith Gill look at charts. This real eccentric guy with his, Roaring Kitty name and the headband. But with all that aside, we would actually conduct pretty productive research. And lo and behold, Rod came up with the idea of creating a website to publish a research report on GameStop to kind of get the um, really like misunderstood story corrected, right? Because we had Andrew Left's Citron research report coming out that would talk about how the stock was going back down to 20 fast. At the time, it was trading for about 40. So he thought it was worth about 50% less than it was trading for, which even 20 for us, having invested in the single digits was great. But still, we thought it was worth more. We wanted to rebuke that misinformation campaign, launched GMEDD. It all started really in the Roaring Kitty streams, which is great. And then years pass, and I continue to research GameStop. I continue putting out stories on the stock. Like, I'm no journalist myself. This was all my first time doing anything like this. But because we had built this community on Discord with thousands and thousands of members, it wasn't so hard. There's tons of people willing to contribute, willing to find out different things going on within the company that weren't public, right? Like, weren't publicly announced. They were talked about like on the job listings and on LinkedIn, but that you had to search for them, right? Because the company was really operating in secrecy. So through creating this community on Discord, we were able to crowdsource all of our research into the company, and that's why GMEDD was always publishing stories that other outlets weren't aware of yet. Like, no one knew GameStop was launching an NFT project. No one knew GameStop was hiring NFT developers. No one knew Loopring was the partner. Those were all things that, having built a community of thousands of retail investors, working together, we can pick up these breadcrumbs and put together the pieces into like a puzzle. And the finished puzzle was always those uh, reports on the GMEDD website, those stories. So super proud of that. And moving forward, we're always been interested in more equities than that. The server talks about more than just GameStop. And that's how we see the platform transitioning. We'd love to continue to research GameStop as well. We're very proud of our roots, but there's other opportunities in the market as well. You can't, really believe there's only one stock out there. So part of that for us is expanding GMEDD into a more broad platform where people can crowdsource equity research and work with others on more than just one stock. It's simple, but I'll let Rod kind of explain a bit about why we chose PLBY as our first equity research report and how he feels about it.
Well, thanks, Joe, and I hope that was good information for some folks. I'll also go back 5 or so years and kind of talk about how I first became involved on social media discussing investing and investments and stocks. And look, I'm going to read a disclaimer because I work for a family office. Joe works for a family office. We work for a private investment fund, and we want to make sure that you're aware that we are employees of Wook Capital Management. And I do want everyone to be aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients. We do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on any information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. And Joe and I both know firsthand how desirable it is to deal with SEC enforcement. We both went through subpoenas related to our involvement in GameStop. Throughout that process, it cost me a lot of legal bills to comply with because I had spent most of 2020 pretty obsessed with the stock. I was all over the internet. But let me go back to 2018. I got on Stock Twits. I was interested in GameStop. That's when things started to happen with the company with regards to the push for strategic review. That strategic review went on over the balance of 2018 and early 2019. The company resolved to dispose of its Spring Mobile business. And later along in 2019, it zeroed out its dividend, sent the price to the floor. A lot of people were highly confident that the security would be zeroed out and took massive short positions in the security. Later in August of 2019, of course, Michael Burry wrote the board a letter. I believe at that point, pre-split shares were in the $3 and change point. Myself, Mr. Burry, and Mr. Gill, independently of one another, had massively accumulated options and I think shares during that summer of 19, which if you were invested in GameStop at that point, you remember how god awful that was. I was on vacation with family in Hawaii buying GameStop call options for Jan 21 that did work out well. But I was very, very wrong for multiple years on the investment. I got to meet a lot of people as COVID hit in 2020, as we all kind of branched out to these different online communities, whether people getting active on Twitter. I hadn't used it since undergrad. I started using Twitter again, using Stock Twits, Seeking Alpha. As Joe mentioned, I was pretty much my girlfriend is still probably mad about this, but like for almost all of August 2020 through till Jan 21, I was Monday, Wednesday, Friday tuned into Keith Gill's Roaring Kitty streams. And remember, we didn't know his name at the point in time. We just knew him as Roaring Kitty. We didn't know that he was also the deep fucking value Redditor. So that got revealed on Christmas of 2020, which was wild. But just a little more detail. I'd gotten to know a lot of investors over the years. When I make investments, it's typically viewed as an investment. Investments have multiple year durations in my investing view. So I had followed the company very closely. We got into late 2020. There were some actions taken by the C-suite that I disagreed with. Mr. Cohen wrote a letter to the company in November 2020. I went around and reached out to some of my fellow investors, let them know what I intended to do, which was to send Mr. Cohen a letter pointing out that we support whatever it is that he may do come the 2021 proxy, which I sent that letter some point in December, and within a couple weeks he settled with the board. That letter was on behalf of 4% of shares outstanding, which was just me asking a couple dozen people I knew who were investors. Folks may not know that John Kim, our CIO and the founder of Wook Capital Management, was the largest outside retail investor in GameStop heading into January of 2021. And that fortuitous turn of events as Jan 21 went along, as we put out our research report, which the Cohen settlement happened on January. It was that weekend, January 11th, I think was the Monday, right? So that news came out, and to me, that was where it was okay. We finally have enough clarity to decide to compile all of the research that has been done by myself and by other investors over the years into one viewpoint, one report that coalesced into the PLBY-DD report that we published. I was very proud of the work that went into that report. I had the opportunity to go on to Benzinga and Bloomberg and talk about my experience, which was incredible. I never would have imagined it. I certainly never imagined that it would trade up to nearly $500 pre-split, but things happened. After that, I was still a full-time employee at Ryder throughout the course of 2021 until I was hired at Wook at the beginning of 2022. So we've now been working on trying to build up our capabilities, our thesis, which is at wookcapital.com/about us. You can read about some of that kind of thesis. I'll try to distill it down to the view that our lived experience around how valuable crowdsourced research proved to be in the GameStop saga is something we believe can be applied and recreated over the entirety of the market. Find nuanced insights, find deep nuggets of knowledge that, whether it's through someone's personal lived experience, through the role they have, through whatever it may be, that people can dredge up and uncover. Because I don't really subscribe to the efficient market hypothesis. I think that mispricings exist, and I believe that there are ways to get deeper insight than the market has, and it involves a lot of work, and you also will be wrong. So I've been wrong about PLBY since, from a share price perspective, I've been devastatingly wrong on a personal basis. To kind of, I guess, I want to round out the GMEDD discussion. We're published the PLBY DD report. This is the next report. It's not that the server is now a PLBY server. It's that we're trying to point out that, in this case, we're putting out research on what we believe to be a deeply misunderstood opportunity, similar to what I believe GameStop was. We're going to walk through the report and kind of walk through our thinking on potential scenarios that can happen. But look, we don't have a crystal ball, and we don't have control of the board. So I'll do my best to note the things we believe, understand risks to that viewpoint. But look, I was a retail investor for years. I now am a professional investor, you could say, but I still think about myself as a retail investor. I never worked on Wall Street. I never worked in a kind of a professional, like a hedge fund or anything like that capacity. So a lot of this has been a learning experience for me over the last few years, and certainly gotten a lot of stocks wrong. I've gotten some right, but this is simply the next step for us. There will be more reports to come, we hope. We hope others will join and participate in the community, share their perspectives, their insights, their experiences, hopefully uncover some interesting investment opportunities. Joe, I don't know if there's anything you want to add.
Can't say you really missed anything. I will ask Rod, when did you first start looking at Playboy?
So the company that is PLBY Group was formed out of a de-SPAC transaction. It returned to public markets in February of 2021. One of the investors I'd befriended along the way, who was published in Barron's discussing his viewpoint on GameStop in February of 2020, had put it on my radar. It was a simple, what do you think this brand is worth? And to this day, the brand and the core licensing aspect of the business was one of the reasons why, while I think a lot of SPACs should never have came public, or whatever, I think that this actually had a real business. Granted, I'll throughout the discussion note how wrong management has been along the way, and unfortunately, the incumbent management is still at the helm. So there's been a few other reports out in recent weeks, people noting, and I've spoken to many investors, many of whom have noted they won't be touching this until Mr. Cohen is gone, and I fully respect that. But I also think that's part of the reason why the opportunity exists today. So, okay, let's switch it over to, we're 20 minutes in, let's switch it over to PLBY DD. So we put out 3 documents.
Yeah, Rod, are you screen recording? Let's make sure we get this and we can upload it to the YouTube afterwards for people that miss it.
I am not screen recording.
All right, good point to start. And make sure anyone that's not tuned into the GMEDD.com Discord, it'll be on YouTube afterwards. Otherwise, you can join. Links in our Twitter bio.
How do I screen record?
Do you have OBS? Just use OBS.
All right, I'll use OBS. I wasn't gonna, but okay. 1 second. Sorry, I'm trying to manage a few screens here. Appreciate folks' patience.
Anyone that thinks we've been infiltrated by Wall Street, look at us. We're buffoons. we're over here trying to figure out screen recording live. I did see somebody said, there's no way that GMEDD hasn't been infiltrated. Look at this guy's glow up since the Ryan Cohn interview. That was the nicest roast I'd ever read in my life. Thank you, whoever said that.
All right, hang on. I'm just going to switch my screens around so that I can start this recording. You guys know I'm referred to as Rod Alzheimer in the Discord all the time, so I'm not I'm not technologically advanced. All right, Joe. I press start recording. I've got it on my OBS. I am sharing the screen in Discord. It looks like people can see it, so I think we're good to go.
Awesome.
So what initially, as I said, was getting to got me interested in PLBY was the notion that you had a replicable brand with substantial contractual license agreements for high margin cash flows at the core, and that the operators in charge were effectively looking to do this kind of sexual wellness, if you will, kind of roll up strategy. I wonder if I should start with the asset deck because that kind of walks through the story a little bit. So maybe let me start there, and I'll start, I guess, further back, right? So Playboy, I think most people, in fact, statistically, almost all of you in the room, everyone but maybe one person mathematically has heard of them before. So to the one of you who hasn't, Playboy, was founded by Hugh Hefner in 1953. It was kind of, your original lifestyle brand, if you will. It was oriented around sexuality, personal freedoms. Of course, the initial product, or the core product for the company for many years, was the magazine. But it was more than just that. There were Playboy clubs, mansions, etc., throughout the world over the brand's golden years into the 70s. As the 80s came along, there were competitive programming to the magazine. There were your Maxims, your Lad Mags, if you will. There was video pornography, and of course, as we get into the 90s and beyond, internet pornography that challenged that legacy business that they had. So, the magazine business eventually became a money loser, and the company incurred significant losses during the GFC. The brand, or the company, was finally taken private by Hugh Hefner in conjunction with Rizvi Travers. Suhail Rizvi is currently the chairman of the board and the largest shareholder in the company. We'll get to that. But it was taken private in 2007. Remember, this was just Playboy and all of the accoutrement at that point in time. So I kept printing the magazine throughout the 2010s. Magazine kept losing money. The licensing business, which has predominantly historically been out of China, continued to grow during that time. The CEO who had been in charge of the company, Scott Flanders, was replaced in 2016 by the current CEO, Ben Cohn, who is, or rather was, a Rizvi Travers managing partner during that initial deal. From my conversations with many investors, the only reason Rizvi became involved in the brand initially is due to Cohn. We'll talk more about that. And he remained CEO and on the board. So Hefner died in 2017. The balance of what he owed, his estate sold that remaining 1/3 back to Rizvi Travers, or to Rizvi Travers, for what I think was an absolute steal. A third of the company for $35 million in August 2018. Estate sales are a good place to go buy. So under Cohn's leadership, they began pivoting to this direct-to-consumer model. So this began in late 2019 when they announced the purchase of Yandy.com, which does still exist. They don't own it anymore, but Yandy.com is a kind of a cheap platform for lingerie and costumes. Talk more about it. So they bought that. They published the last physical magazine, at least US physical magazine, in March of 2020. COVID hit. So they were already pivoting away from the physical magazine. The impact of COVID, I think, was a kind of a final writing on the wall for that. So later in October is when they entered into the business combination with Mountain Crest Acquisition Corp, the SPAC. So that transaction closed. They returned to public markets in Feb 21. The intention of the deal was, of course, to raise some capital to accelerate product development and more rapidly build direct-to-consumer capabilities. So in line with that, after they came public, shortly thereafter, they bought a sexual wellness, a sex shop chain, if you want to be crude, called Lovers, which is largely out west. They paid $25 million cash for that business. They also raised another $203 million in June of 2021 in a follow-on offering. So they sold several $1 million shares for 203. It was a net after fees capital raise at $43 per share. Almost all of that capital plus some equity went to fund the acquisition of an Australian luxury lingerie and sexual wellness brand called Honey Birdette. So that deal was announced with a headline price of about $333 million. The final transaction amount was a bit less as the share price declined. It was about 2/3 cash, about 1/3 PLBY shares to fund that deal. So getting us farther along, now we're still in October, or I'm sorry, we're in August 21. So around that same time, right? They just closed on the Honey Birdette deal. Around that time, for those of you who remember, OnlyFans, which has been booming, is still booming, but had really been blowing up amidst the pandemic. The company had briefly explored banning adult material in August of 2021. So kind of that self-inflicted blunder, I think, accelerated the idea in their head that they could compete with OnlyFans in that kind of creator platform space. The company spent $30 million in shares to acqui-hire this startup called Dream.me, which would eventually kind of lay the foundation for the creator platform that they have today that's still very much in a startup phase. They also, of course, launched an NFT project in late 21 because why not? They raised a little less than $10 million in Ether. Then we go into the late 21 and the launch of the Centerfold project, which was what they called their creator platform at that time, really didn't go very well. They'd go on to enter 22 with significant turnover in the NFT team. In that creator platform team, Honey Birdette's founder left in 2022. A lot of bad stuff happened, right? A lot of turnover. In my conversations with former employees, the message has been consistent that Ben Cohn is trash, and you will hear me refer to him as trash. If you haven't read my Twitter before, it may come as a surprise to you, but I don't have a great perception of him as a leader. So, continuing along, we get into the summer. The company does this private placement of preferred stock that they co-announce with a $50 million share repurchase program. So they did that in May. Very questionable. As of post the first quarter close, that preferred stock is no longer with us, but I'll leave that till a little bit later because when you pull the stock in a screen now, because it happened after the quarter close, I think a lot of people still think that is on the balance sheet. And the balance sheet looks a lot different post-quarter close than it did as of the March 31st balance sheet. So, yeah, I don't want to jump ahead to that. And later in the year, right, they'd also purchased a private jet called Big Bunny that they had been flying as a means of kind of driving brand awareness and engagement. They ended up selling the jet. I'm jumping ahead again a little bit. So, okay, in August 22, during the second quarter 22 earnings call, they reported that global macro headwinds led them to suspend their guidance. They drew down the balance of that preferred stock to raise cash. They paused their Honey Burdette store openings, and they commenced the strategic review. Um, they did one of many amendments to their existing credit agreement at that time. So that was when I really first started thinking of putting something out, because that's when I started to see a very, I guess, a growing disconnect between our view of their assets and their business values and how the market was treating them. I also began to publicly call for Ben Cohn's resignation at that time, so a little less than a year ago. I shared my initial sum of the parts analysis on my Twitter in early September, shortly after the sale of that private jet I was referring to. So then, of course, if you look at the financial statements for 2022, on their face, just like with GameStop in 2019, there were significant asset impairments, non-cash. But when you look at the results, right, if you have a $302 million non-cash brand and goodwill impairment in the third quarter, that's gonna devastate your actual financials for the year. So um, they did that. That happened. They again amended the credit agreement after the third quarter. So they announced a subscription rights offering in December of 2022. They ended up grossing $65 million from that capital raise, which of course diluted anyone that did not subscribe to it. Um, that did enable them to pay down $70 million in debt in February of this year. They got another waiver of their debt covenants at that point in time. And then, as I noted, there was an amendment on May 10th after the first quarter ended. We haven't gotten second quarter results from them yet. That'll come out in about 2 weeks' time. I don't think they've yet announced it, but it should be about 2 to 3 weeks from now. But after the first quarter ended, 2 months ago, we got another waiver where they have all these covenants, minimum cash, leverage, all of those covenants were waived through the first quarter of 2025. In conjunction with that transaction, Fortress, who is an equity owner in the security as well as the owner of now about 90% of the debt, who had been the owner of the preferreds, entered into an amended and restated credit agreement. So Fortress now is their creditor effectively. And that all happened, getting rid of the preferred stock after the first quarter ended. So since that August 22 earnings call that I was referring to, their market capitalization has shrunk from around $340 million to 120. I don't know what it closed at, what, $1.80 today. So we're talking about a $132 million market cap as of today's close, and a pro forma enterprise value of about $305 or so million. So, I would emphasize part of that dislocation is as a byproduct of the liquidation of the largest external shareholder, Builders Union. Builders Union owned 8% of shares outstanding as of year end 2022. I'd had several conversations with Marcus and the managers at BU over the last year, and it's regrettable, but when you're managing other people's money and you don't do well, unfortunately, you get a tap on the shoulder and you get forced liquidated sometimes, and that's what happened with them. So from February 9th, when they began to exit the position, through till early March, shares dropped another 30% as they were an indiscriminate seller during that time due to their liquidation. So that transpired. You also had the company removed from the Russell and had index deletion happen over, about a month ago, right, in June when that concluded. So, when you think about as ugly as it gets on its face, it is hard to find an uglier situation or a hairier one. But I think that's where sometimes, perhaps, you can find good opportunities. And while I am the first one to acknowledge I've been wrong on it. I do disclose my personal account on a quarterly basis. You'll see I did meaningfully increase my allocation to the stock during the second quarter because, look, everything has value. If you believe that the security is going to undergo, a Chapter 11 restructuring or something, then absolutely. And we'll talk about some of the risks and certainly address bear cases and field Q&A when we get through this. But I actually kind of see it as, it's almost like what's left. It's really hard for things to go much worse from here. I'll lay out my view on what comes next in a minute, but that kind of brings us at least up to where we stand today. And look, management failed to deliver on that original strategy. We noted they underwent the strategic review, and as of the most recent quarter's transcript, you can see that they've really done a whole 180 from what they initially came public for. They came public to do this roll-up strategy to grow the direct-to-consumer business, and they, as of the fourth quarter 22 call, have done a full-on 180 from that. They have completely gotten out of their direct-to-consumer business. After they reported earnings, you can see I put in the asset deck that Playboy finally capitulated on the notion they can operate any business effectively themselves and are now pursuing a capital light strategy focused on their licensing business, their Chinese joint venture, and the creator platform. So the business, the luxury lingerie retailer that they paid more than their current enterprise value for in 2021 is up for sale. Moelis is managing the sales process for them. Lovers is also undergoing a sales process by a different banker, and they noted that they're in the process of selling their artwork portfolio. Excuse me. They do have a $15 million repurchase authorization open, net of that amended and restated credit agreement. And this part, I'll note. Look, I do my best to do the best possible due diligence when I'm investigating securities. I speak with as many stakeholders, shareholders, customers, former employees, et cetera, as I can. So I've spoken with many investors over the almost 2.5 years that I've been invested in the stock. So I note in the report, based on discussions with various shareholders that have spoken with the chairman and CEO earlier this year, we believe that the new CFO/COO, Mark Crossman, who replaced the fired CFO, Lance Barton, was brought in to manage the operating business's restructuring as well as asset sales. We believe Ben is solely focused or tasked with the creator platform's success. Our belief is that should the creator platform key performance indicators, KPIs, be unmet this year, that the platform would also see the chopping block. Now, we don't attribute any value to the platform outside of our bull case scenario where it works, but it is worth noting that there could be a buyer interested in paying millions of dollars for the guts that they have of this creator platform. So assuming that the asset sales are completed and that the creator platform does not reach profitable scale, you're left with a company that's just subscale for public markets. So just because they came public recently, why would you be in public markets still? In this case, the mix of total cost for compliance with SOX and kind of public company reporting rules is just so high relative to the size of the business that I don't see why, if you sell Honey Birdette and you sell Lovers and you sell off your artwork and you're left with a sub $100 million run rate revenue business, you would keep that entity public. So that is our view. We lay that out in our base and our bear case scenario. So we do believe that the remaining Playboy business will also be sold. I'm inclined to see it go to an unaffiliated buyer in that scenario, whether that's an existing brand licensing organization. There's several big ones. I know it's been reported in the past that there was interest in 2016 around the brand licensing business. So we'll talk about that more. So the sum of the parts analysis in the asset deck that follows should be considered in conjunction with our PLBY-DD report. We seek to paint a fair picture around 3 prospective outcomes for the company. So the asset deck talks in detail on the value of each of the assets. I'll I'll walk through that quickly before I get to the main deck and then talk through the creator platform model. So we value Playboy's assets as follows. We use bear, mid, kind of base, and bull ranges on each of the assets. So we see the licensing and JV and intellectual property as fetching between 225 and 450 million as a range. We see the net operating losses that they have, which they have in excess of 300 million of them, having real economic value for any prospective buyer of the licensing business who opts to continue operating it. We could talk more detail on it, but we see those as being worth the range of 20 to 25 million dollars. Honey Burdette, which they paid, as I noted, a hefty price. They paid 12 times EBITDA in 2021. We think it will sell between 6 to 10 times what we estimate as kind of a current adjusted EBITDA. It's difficult, and I'll kind of reiterate this. We're doing our best with the information we have. The company does not provide detailed disclosure of its segments in a way that enables great accuracy. So we admit we could be wrong. These assets could sell outside of these ranges, but that's what our work pointed to. I used a 6 to 10 times range when I think about the purchase of Adore Me as it relates to Honey Burdette earlier this year by Victoria's Secret. Again, a strategic purchase. But when you look at them on a comparable enterprise value to gross profit basis, that would put Honey Burdette just shy of $200 million. Look, the Australian economy, I see my friend Mr. Vestro is listening in, and he knows that the Australian retail space is quite challenged. So, when you're a seller in a market that it's a good time to be a buyer, you're not going to get the prices you want. It's entirely possible that Honey Burdette is further discounted and ends up yielding less than we estimate, but that's a risk. The Lovers business that they paid 25 million in cash for, they've talked about that business as recently as the last transcript. They talked about it. They noted in the fourth quarter 22 call that it is currently generating comparable EBITDA around $5 million on an adjusted basis is when they purchased the business. So for the sake of conservatism, we simply did a 2 to 3 times is what a buyer might pay for a small business of that size. And then the artwork collection, which again, very difficult. We don't know precisely what remains in the collection, but what we do know is you can go back and look at what is in the transcript from previous decades, from the prior iteration of Playboy when it was a public company, that they had had the artwork. Oh, let me just go to the art page so I don't lose my thought. They had the collection appraised in the 20 million range in 2007. Granted, they, without knowing what they sold between then and now, it's hard to know exactly what the collection is worth today. If we assume appreciation roughly in line with CPI, the artwork collection may be worth $30 million today. Simply applying a 50% discount to that, though, gives us 15 million. So, we are using a 15 to $20 million range in the artwork collection. And as I noted earlier, they have already sold the Big Bunny jet. They reaped 18 million from that, and they sold Yandy, which, while they paid 12 million for Yandy and they only got 3 million for it, I think it's worth emphasizing that that was a really bad, low quality business that was made worse after the iOS advertising changes took place. And really, structurally, that business has not been profitable for them after those changes took place. So it's been a contributor to operating loss. Frankly, the fact they were able to sell it for anything, I think, was a good thing in order to eliminate that operating loss. And while I don't have it listed in the asset deck, it's also important to remember that I noted they shifted away from the direct-to-consumer strategy. So they had begun building Playboy.com as their owned and operated direct-to-consumer operation. And they still own Playboy.com, but what they've done with the goods sold on Playboy.com, and they discussed it in the last quarter, we don't have the finalized term sheet, but they noted they were signing a term sheet wherein 15% of the net sales through Playboy.com goods, think hoodies and apparel and other accessories, they will simply take 15% of those sales proceeds as a royalty payment now. So they've again replaced a business that they were running at around a 22 or so million revenue rate for 2022, no pun intended, and they were losing money on it. They were losing a mid-high single-digit $1 million annual rate. So they've converted that operating loss into now a royalty stream, which even if we assume that 22 million goes down, right? Let's assume the website only does 15 million in sales. Well, that's now a $2.25 million royalty with no associated costs. So there's been a lot of changes, as you're hearing me kind of note, from what the business was and what it looks like on a trailing basis and what it will look like on a pro forma basis. So I've gone through the asset deck. I'm going to go through the kind of core deck now, because I think that asset deck helps to, you need to read them in conjunction with one another. But look, there's a big, long legal disclaimer. And as I read at the onset, do your own due diligence. We've done ours. We've opted to put this report out publicly, but we're not making you do anything. You can ignore it. You can print it out and burn it if it'll make you happy. If you find it informative and it's the type of research that you'd like to kind of contribute to and be a part of on various different securities, well, then we'd welcome you to be part of our due diligence investor community. There's plenty of stocks out there. No matter what happens with this security, this is again, this was a good faith effort to compile all the research we've done and kind of paint our current view on why I believe and we believe it's misunderstood. So where does that leave us? As we published it on yesterday, 25 hours or so ago, the stock had closed Friday at $1.71. Market cap was 126 million, and the net debt was 174, which put us at a nice square $300 million enterprise value. Playboy thus closed down more than 97% from their all-time high close 2 years ago. And I really want to emphasize that we believe the market is missing the impacts of their recently announced restructuring and the strategic shift to a capital-light operating model. I continue to hear people note that they don't see a future for selling magazines. And when I hear people note that, brings a smile to my face, because they've clearly not done an iota of work on the business. We do believe that the global Playboy brand is irreplicable. I do not believe that you could go out today, create a brand that is as iconic, as easily identifiable globally, as well known, without investing tens of billions of dollars. And even then, you just simply can't recreate the history behind it, of which there's good and bad. And the company is kind of open to acknowledging that with Mr. Hefner as, to some, the face of the brand. He's, remember, been deceased for more than half a decade. His family's uninvolved with the business, has no stake in the business. So, again, I think that people just maybe have a view that's aged, and they're entitled to have a view on some of the bad things Mr. Hefner did. But anyways, we do believe that there's significant upside in the assets. We do expect that to be unlocked through these already announced asset sales, prospectively executing on the creator platform initiative, or through a take private transaction or a full on sale of the balance of the business within the next 6 to 12 months. So, in sum, the bear case points to a $3.05 price objective. It acknowledges the risk of a take private from the currently depressed levels. The 60-day VWAP is around $1.70. So you think about the rights offering that took place at $2.56. So we're talking about a 50% premium to the current VWAP. If a party were interested in making an offer, it strikes me that it would likely come in no higher than the rights offering level, assuming nothing changes between now and then. And I do think that it is entirely possible they could announce a full-on sale of the business as soon as the next earnings call, as soon as 3 weeks from now. I think it's less than likely it happens at the next earnings call. It's more likely it would happen in November at the third quarter result. But I'm getting a little ahead of myself. So the base case anticipates that they complete the announced non-core asset sales and the restructuring at those estimated midpoint values. It does not contemplate any value, as I noted, from the creator platform. In this scenario, it's simply shuttered by year end, not even sold for a penny, with the remaining licensing business sold off, as I noted, subscale for public markets. The bull case scenario, which if you poked your head into our model, we attributed a very small likelihood of, but it's possibility. The bull case, right, would be based on them achieving the necessary scale for reaching profitability in that creator platform, which again, I'll walk through the model after we get through this deck, and then we'll go to Q&A. It would, of course, include thus favorable valuations for the non-core asset sales that they're embarking on, and they would retain the licensing business at that point. It would really just be the licensing and joint ventures and the creator platform. So I'm not going to read through this Playboy story. I hope that I've given a little bit of the story to people's satisfaction about our experience. One thing I will say is I've had many discussions with many investors, many lawyers, many individuals around what to do here. I've noted repeatedly that there is an investor rights agreement that hamstrings prospective activism in the security. But what I will note is that Ben Cohen is up for election at the 2024 annual general meeting. And while I won't commit 100% to running against him, I will say that have been very actively exploring that option. And depending on what we hear at the next earnings call, you may hear, or rather you may see, a letter to the board in that vein. All right. So the bear case, let's go through the cases in a little more detail. I'll try again. It's 5:50 and I've been talking for 40 or so minutes. So I'll try to skim through this a bit. As I noted, this downside scenario assumes the failure of the creator platform growth initiative. They get poor proceeds, which could always be worse for the asset sales that they've announced. The cost cutting that they've undertaken proves insufficient. The remaining business, of course, as I noted, is subscale for public markets. We estimate around 80 million in pro forma annual revenue if you exclude Honey Birdette, Lovers, their owned and operated D2C. So it ends up being a very small, mostly licensing operation at that point, which is actually a wonderful business if it has the appropriate capitalization and doesn't have the associated heavy overhead costs that the business has had historically. So in this bear scenario, we would consider the likeliest outcome to be a takeout by the controlling shareholder, Suhail Rizvi, or a strategic buyer, such as Authentic Brands Group. Authentic Brands was interested in 2016. I've spoken to other investors who have had conversations with people there. I am not privy to any non-public information about it, but I would note it does sound like there could be interest. So we put a graphic on the slide that kind of points out the consolidated insider ownership between Rizvi, John G, who kind of works for Rizvi, and Cohn. We kind of took a swag based on how many shares and options Cohn has to come up with a bit more than 1 in 3 shares are controlled by Cohn, Rizvi, and associates. It could vary a little bit, right? I again use the proxy statement and the disclosure on how many of Cohn's shares and or options would be in the money. So again, it could vary slightly, but generally, I think it paints that picture. And with the investor rights agreement, it's made it very challenging for outsiders to seek to exert influence. So, but what I would point out is there was $99.5 million in subscription indications in the rights offering in February, 5 months ago. So clearly, both Rizvi, who oversubscribed and took his stake from around 20% to around 30%, and others saw attractive returns on capital from that implied $370 million enterprise value. We kind of see that as a little bit of an indicator of interest. So the timeline for this scenario sees all of PLBY formally put up for sale as soon as next quarter. I would remind everyone that's not what I'm saying as a base case. I'm simply saying it could be announced as soon as the second quarter result in a few weeks here. It's much more likely that it would be in either the third or thereafter. So in this scenario, though, when we kind of break out the values we see for the respective assets that are being sold, we back out the net debt, leads us with about $3.05 in equity value per share, which obviously relates some significant upside from the current close of $1.80. Next slide here kind of points out just how much end sales are driven through the Playboy brand globally. So, License Global puts this report out once a year. The next update is actually supposed to come later this week. So, Joe, I think we might update this slide with the new data. But as of 21, which was from the report out in July 22, you can see that Playboy Enterprises generated around $3 billion in end sales on its licensed retail product. Meanwhile, you can see the massive spread between the valuation of the company's market cap and its enterprise value today relative to these other companies on the list, these other global brand licensing operations, many of whom brand licensing is not their core business, but some of whom it is. So we put that slide in to kind of draw attention to the size of Playboy's global reach. Okay, base case. So in this scenario, we see them concluding these asset sales that have been announced. They sell Honey Birdette for 180 million, Lovers for 12 and a half, the art collection for 17 and a half. So, right there, that's $210 million. The net debt, the total debt, excuse me, less leases is right around $210 million. I don't believe there's a need for this business to fully delever. The contractual licensing cash flows strike me as something that could support substantial leverage, especially in a private scenario. So while I do think they will use the debt proceeds to delever somewhat, I don't expect them to pay off their debt in full. I think that they will retain leverage on the licensing operation. But regardless, in this scenario, the creator platform is closed by year end. It's no longer consuming cash. We believe that Ben Cohn would no longer be CEO in this scenario, as we believe that the last bullet left in the chamber, so to speak, for him is a successful scaling of the creator platform. So we do see that they recently finalized changes to their China to their business in China. They entered into a joint venture in China with Li and Feng's Charactopia outfit to manage the business onshore China for them. They gave 15% of the JV as kind of a seller financed way for Li and Feng to earn that business. And when you think about the current way the business works, where they're paying a global licensing agent a 25% take, we do see that their shift into joint ventures as an accretive kind of stance. That global licensing agent contract doesn't end until 2028. So we're talking long term, but it obviously is accretive for margins incrementally if they're able to keep more of those licensing dollars flowing through to gross and hopefully net profit. So they've noted that they've identified $22 million in overhead cost cuts since bringing Crossman on. But even net of those cost takeouts and the asset sales, we'll just reiterate the point, even in this base case, that we believe the remaining licensing and joint venture operation will be too small to remain public on a standalone basis. And we expect that it will be sold in some capacity, which we use $337.5 million as our valuation for the midpoint there, with that coming as soon again as next quarter. So next page touches on, so this is a survey that I was made aware of from the guys at Builders Union. They are the ones who ran this survey, as a matter of fact, on Gen Z. So there's two surveys actually on this page. There's the survey done by Hedgeye in May 2021 about have you heard of Playboy, where you can see that even from the 18 to 24-year-old sect, you're talking about 7 out of 8 having heard of the brand. The other survey that you see on the right side of the screen talks about the 90% global awareness amongst Gen Z, that 60% view Playboy as a different brand today than its past of the Gen Z population, as well as the company noting that 2/3 of their audience is under 34. So people think who would be a Playboy consumer or customer, and they might think an old gentleman. And while historically that was true, it's now more of a 50-50 split between male and female consumers, and there's a bias towards younger consumers. So Builders Union did that survey for consumers in the US, the UK, and China for those Gen Z responses. Obviously, the company added those data points to their latest investor deck. So while I had kept the confidentiality of Builders Union, now that the company has put those numbers out and Builders Union has failed, we've opted to kind of put that here. And I just wanted to add that little bit of context that they'd run the survey just toward the end of 2021, what they've done this and come out with this. So Gen Z, 9 out of 10, if you're talking about those three markets, are aware of it, and a majority view it differently than in the past, which I think surprises people. It has surprised people when we've talked about it. Okay, the bull case. So I will wrap up with some positivity here. We'll go through the bull case and then go through the creator model somewhat, and then we can field questions. And we're at 6 o'clock. My intention is to run this for as long as we have questions, so it could go to 7. I would love to be able to not be on a call straight through to 9 o'clock, though, since I have 2 hours of team calls at 7. So let's see where we wrap. Anyways, bull case. A rabbit is pulled out of their hat. Playboy's OnlyFans competitor sees some significant growth and non-core asset sales are successful. So in this bull case scenario, we attribute the bullish valuations to the announced asset sales and assets that they will be retaining. We see their creator platform growing enough to reach break even, which, as we'll talk about in a second, right now, break even requires about a $45 million gross merchandising value, GMV, on the platform. We do see a path to that, but we'll get there in a second. Based on the scenario we lay out in the model, we see run rate GMV reaching 70 million by year end, 190 million by year end 24, and 330 million by year end 2025. The creator economy, the statistic that I've seen thrown out most recently, is in excess of $100 billion. When you think about the size of OnlyFans, the implication is that their creator platform would reach about 1 to 2% of the size of OnlyFans by kind of the out years in that forecast model. So we're really not talking about a massive disruption of OnlyFans. We're really just talking about it getting to scale. And as you'll see when we go through the model, it's quite a wonderful business model for them. So, we go kind of and apply an exit multiple on the 2025 estimates. We looked at Match.com as a potential public comp. We discounted the multiple that we applied because it's a somewhat inferior business. There's a higher degree of transactionality versus contractual revenue in the model. So using a 12x EBIT multiple on the 2025 EBIT discounted back to today's value spits out that the creator platform is worth nearly as much as the current enterprise value today. Again, no one knows if it will or won't be successful, so it's just a scenario. We included some of that analysis, some of the data behind what management has shared about the platform. So we do note in bold, we do not believe Ben Cohen's leadership can achieve this. A replacement is likely required to achieve this scenario. Okay, so let me go to the model then, which we kind of included on page 12 and on page 13, little kind of one-pagers. Page 13 is a real good little one-pager of the model. I'll pull up the actual Excel and kind of let's look at that for a second. So you can see we have our kind of some of the parts summary on there. So it's really a very simple financial model. Right now, there's only so much information. I clearly opened an old file. Joe, I think we need to re-upload the model that has the formatting, by the way, that I sent you yesterday, because the one that I just downloaded, I think, is still old. But anyways, doesn't matter. Numbers didn't change. You can see that the way this model works is the company's told us about their current registered user count on the platform. It was at 1.4 million in March when they reported fourth quarter 22 earnings. It was 1.9 million in May when they reported 1Q earnings. The active creator count is what drives this model. They reported they were around 1,500 active creators in March. They were around 2,200 active creators in May. So what I did here is put a forecasted weekly growth rate for them. You can see how many active creators are added on net week over week. You can see that we simply keep a steady average for what the active creators annual GMV would be. And it's simply a product of how many active creators are there. So this model, again, we see a low likelihood of this scenario, but in this scenario, the active creator growth continues. We eventually reach kind of run rate break even that 45 million mark by September in this scenario. Now, remember, they reported in May. I want to applaud the members of the GMEDD Discord community, the due diligence community, who've been doing fantastic data scraping from the Playboy creator platform over the last several months, scraping various pieces of information. I don't want to disclose too much, and I don't want to call them out because they've largely remained private, but kudos to you guys. You know who you are. Thank you for your sharing your insights and the detail that you've been able to glean from the website. So this model relies on both some of those insights as well as what the company has stated publicly to kind of come up with a scenario where we see, again, in 2024, in this scenario, we see the platform's GMV for the full year being about 130 million. Now, Playboy takes a 20% cut of the platform GMV, so that would be their revenue that they recognize. Then there's costs. So there's a variable cost component, which they had discussed as implying high single digits. In the latest call, they had discussed halving that. I don't really want to believe them, so I keep the variable cost at 7%. And the fixed cost that they discussed is about $500,000 a month. So that's 6 million annualized. I have that inflating somewhat by about 3% going forward, but I keep fixed costs pretty flat because there's really not much in the way of incremental fixed costs to support a creator platform. So in this scenario, you see that by 24, they would realize a little over $10 million in operating profit with a 41% operating margin. By 25, that would be about 27 million at about 53% operating margin. So again, that the present value of that 2025 operating profit is where we are coming up with our estimate for the platform at a 12 times multiple on EBIT of a bit over $250 million. So, Joe, I've talked a lot. I know that people probably want to listen to anybody but my voice. I'm going to pause there. I think that's it to kind of go through the material. I'm happy to field questions from folks in Discord and or live here on Spaces. Again, as a reminder, we've recorded this discussion. The replay will be available on our YouTube. Of course, the Twitter audio-only replay will be available on Twitter. And the materials are available at both plbydd.com, the asset deck at assets.plbydd.com, and the financial model at model.plbydd.com. So, Dilly, you'd requested to come up and speak. And then, yeah, anyone else who wants to ask any questions about any of the logic, the scenarios, happy to field what I can.
Yeah, we'll run Q&A for a little bit here. Anyone that wants to come up, just hit the request button, and then we'll bring you up. We'll try to prioritize people that we're a little more familiar with that have participated in discussions in the past because we know they can provide valuable insight. But anyone's welcome. Throw up your hand, and we'll throw you up here. Dilly, why don't you start?
Hi, guys. Thanks so much for having this space. So I'm kind of curious about, I know that Hugh Hefner is since gone and his family is no longer involved. Have you guys watched Secrets of Playboy? And do you guys, if you have, there's a second season out now that just came out on July 10th, I believe. It's 14 episodes. In the first season of it, they went pretty deep into how Playboy made their back off of exploiting women and um, in a way that has since pissed off a lot of women that were ever involved in the company. And I feel like have kind of tarnished the name. And so I know that that's like the legacy brand, but I'm curious about uh, your thoughts on the impact of that, especially considering like the ties to Bill Cosby and Peter Nygaard. If you have watched that docuseries.
Haven't watched it. I know the company's put out a victim statement. I was trying to locate it
Yeah, it's kind of bullshit. Like
unsuccessfully on the go. But
they're
no, I haven't watched any of the documentaries,
okay.
frankly. And I think and people are entitled to say, and victims should be heard. And it's tough when you have somebody who's deceased, not able to defend themselves. But if people have
Well,
been
I mean,
victimized,
I
their voices
I
should certainly be
do
heard.
know quite a bit about this company from that side of it because I was just a big fan of Playboy, like a lot of women my age that watched like The Girls Next Door, and my mom actually adopted a dog from one of like his ex-girlfriends. So I do see like from the people that I follow on the internet, this is kind of silly, but I do see a lot of people that would be potentially interested in like the creator space or um I guess like people that were fans of the brand name before like are completely turning their backs on it. So I just am curious like your thoughts on like the impact, or is that like something you're going to look into, like the docu-series at all? Because I do think that that would probably impact the name. I don't know.
I don't intend to watch the documentaries, no, but it is certainly a risk and a concern. So, Mr. Squeezes, you have a question?
The the creator platform had a 25x EBITDA.
I did not.
You did not. Was there a multiple on the EBITDA that you talked about?
I did. I talked about the 12 times multiple on EBIT and talked about how Match Group is the best public comp. We
But nothing about.
can see that their EBIT multiple is about 15, 16 times. So we opted to use 12 times, which is also discounted to the balance of that sort of software space from Professor Demadarin's
Yeah, I
data
had you
set.
on that part.
So
Nothing about the EBITDA on the creator content side of it.
I just said we used an EBIT multiple on that 12 times for our base case.
Okay, I must have been smoking my crack then. Thanks.
Sure. Mr. Vestro, sorry, I don't know if you came up first or Jimmy, but
Well, I'll go first, Rod. I just got here. I just want to say thank you for putting this together. You've done the research. I think you know where I stand on this name. I wonder, is there anything particular with the timing of the release of this report? You know, as you think about either catalysts or other fallen angels that are down 90+%. I guess why now? And you know, within the broader landscape of consumer discretionary, other kind of distressed opportunities, are there any other parallels, any other names that you looked at before you put this together?
uh, I will say, had it been my sole decision, the report would have been out earlier. Uh, it was not my sole decision, but um, I think it's less to do with the broader landscape and more to do with we had put all this work together. We were very consistently hearing people getting it completely wrong. So we wanted to paint our picture similar to what we did with GMEDD. put it out there and express our viewpoint. As I noted just before, and as I've noted for most of the last year, I believe Mr. Cohn should resign. I also believe if he refuses to resign, Mr. Rizvi should fire him. And he is up for election at the next AGM, and I am likely to oppose him and seek his board seat in his stead. I have limited power as just me. I can only do so much, but I hope people recognize that I don't do these things willy-nilly. I'm very serious when it comes to investing, and this, while the investment has not gone well, continue to explore all options to realize the value of the investment. And I would like nothing more than Mr. Cohn to do the right thing.
Me too. Me too. But yeah, I'll be on the line. Happy to take or give you my comments as we get more Q&A. But thanks again to you and the team.
Rod, I guess I'll ask you.
So
So we've outlined
yeah,
a bear case, base case, and a bull case. Do you have an exit strategy? Is there a price that you sell?
I think anyone who's listened to me talk before knows that, in my view, forward returns are what matter. Your cost basis is irrelevant, but for tax strategy, the market doesn't know what you paid. The market doesn't care what you paid. All that should matter to you is what you believe the forward returns will be. And I do believe, from the depressed levels it trades at, that the forward returns should be wonderful. My exit strategy, I mean, I publish my personal account on a quarterly basis. As I noted in the discussion, it is my largest personal holding. It is a mixture of common stock and call options, so I would reduce my exposure if the share price went up meaningfully. That's mathematically how it works. If the share price goes up a lot, your forward returns go down, your risk goes up. I kind of point that evergreen tweet out a lot because it has no bearing on how much you like or dislike the stock. It should come down to what the math says, and this is our view on what the math show. We certainly could be wrong. Mr. Cohn could certainly destroy more value, but with earnings coming in 2 weeks and what I've alluded to, potentially needing to ramp up, look, the AGM is a ways away still. So, there's certain steps that must be met in terms of notifying the board of your intentions. So we're not just there yet, but I hope people realize this is not a joke. Deadly serious. Okay,
Well, go ahead, Squeezes. I see you raise your hand.
Yeah, in your opinion, what are the three major missteps that Mr. Cohn has made to tank the share value from a year ago?
I mean, the first, the overarching sad reality is that Mr. Cohn couldn't run a lemonade stand. So
those can be tough.
Gotta get the portion of sugar to water just right. So
yeah,
the thing that I think I want to emphasize is that the strategic shift away from direct to consumer and owned and operated businesses to focus on the asset light approach, I believe that's the right choice and the right decision that was made. That they announced in both the 10K, when they put out fourth quarter results, and kind of emphasized again with the first quarter result when they noted formally that Honey Birdette's for sale. So to me, it really boils down to the fact that this guy couldn't run anything, has really been at the helm now for 6 years, has not been successful in just about anything other than the follow-on share issuance at $43 per share, which, had that not happened, the situation would be more dire. He's not a good leader, from what I've heard from ex-employees. He's just a god-awful leader. There's just nothing good I can say about him. I'll note, we first met with Mr. Cohn and Mr. Barton in about 18 months ago. In early 2022, we digitally had a conversation. Myself, my CIO, John Kim, met with those two. Okay, that's fine. John had lunch with Ben several months later, and feels as though he was lied to his face by Ben from what he said about their intentions regarding the share repurchase authorization they put out in May and the preferred stock issuance. I would add, Mr. Cohen was late to the meeting because he couldn't get valet parking. So this is not the kind of guy who's going to go park, in a parking meter that still has some time left on it, like a Warren Buffett CEO of yore. This is a guy who is very wealthy, who worked in private equity for many years, who feels insulated from my continued calls for his resignation, and he shouldn't be. He shouldn't feel insulated. In the proxy vote this year, there were about 8 million shares voted against both of the directors. And if you back out the insider votes for the directors, you'll see that it was a 2-to-1 ratio against. And those directors are no-name people that no one really care about. Mr. Cohen and Mr. Rizvi are both up for election this coming year. And I don't know that they're going to want to deal with it, frankly. So we'll see what happens. But yeah, I don't have anything nice to say about Mr. Cohen. Mr. Gentile, Mr. Schenker, sir, the floor is yours.
Putting this together, I know in your 3 cases you have a range between 225 million and 450 million for the licensing business. Can you explain how you get those ranges? Because they're a core part of the valuation, aren't they?
Sure. So as I kind of alluded to earlier, it is tough because of how they disclose their segment level results. We can see that the licensing operation on a segment basis, when you back out the non-cash impairments, generated about $42 million in operating income last year, right? So there is clearly overhead cost that's not being burdened at the segment level that would exist. But we tried to take a view of kind of using that operating income, using our consideration on the changes in the China JV, which there's a lot of uncertainty around. I changed my screen for anyone who's following along. You can see I'm on the page in the asset deck, page 9, that talks about the global licensing business. So there was 61 million in revenue, 42 million in segment operating income before those impairments. They also, per the 10K, which this data is now aged, but it's the best we have, noted that they had $350 million in unrecognized contractual revenue minimums through 2031. Now, this China joint venture, they've discussed seeing an improved percent of sales that they will receive. So they'll get a higher percent cut of the end product sales, but that is offset by lower guaranteed minimums. So we don't have insight into how far they've lowered those minimums from that $350 million level. We also don't know how high that take rate has gone. So there is certainly uncertainty in the analysis of the value of the licensing and JV businesses. Would know again that there's the $3 billion in global spend against the brand, and that about half that comes from China, with about more than a third of it coming through China e-commerce. So this JV structure is better than the global licensing agent structure, where they've given Feng the ability to earn up to 15% out of 250 million valuation for the China JV. So that would imply that and we didn't include it in the report, but they, in theory, as far as we can tell, could also sell off portions of the China JV if there were buyers interested to further kind of monetize that asset. We didn't really include that because it's hard to parse it all out, but that's another aspect of it. So yeah, we kind of see it as it's an operating segment that's highly profitable. There's a lot of noise around with the overheads. What is the true profitability? but that's how we came up with kind of the 2.25 to 4.5, 450 million valuation for the global licensing and JV businesses.
Thank you.
It's helpful.
Yep. Thank you.
Okay, Eric, I'm bringing you up. Please go ahead.
Hello.
Hello.
Yeah. Quick question. Of your bull thesis, how much of that is the short position estimated into that, the acknowledgement of bull thesis?
We didn't discuss the short position whatsoever in any of the analysis that was put out. So I would say it's unrelated. I would tell you, at least from pulling it up live, that per S3 Partners data, it's about 6.5 million shares short out of the 73.6 shares outstanding. Obviously, the float is smaller due to the insider ownership. So whatever float calculation you want to take, but there's a modest short interest, but it's very tertiary to any thinking here.
Gotcha. Thank you. I would think that most of the listeners have been following you from the GameStop saga, where that was the initial attractive measure to the play. But thank you. Good work. Appreciate it.
Just for the record, that at least for me personally was never a primary consideration. It was certainly an element of the tail outcome that was realized, but I would just, in general, if you're making an investment decision, sure, as we've seen with both AMC common stock over the weekend, and the after hours announcement with Carvana over the last couple of weeks, but other than noisy share price moves related to long short dynamics in the short run, I would say that it shouldn't play into your longer term investment thinking, is my viewpoint. But appreciate your sentiments, and I hope that answers it. Jimmy, Eric, or Chantil, do you guys have any other questions? Otherwise, anyone in the audience who wants to come up, Vestro, I know you came up briefly. I didn't hear you, but it's 6:30. Willing to keep this open another 30 minutes to the extent we have questions.
No, I'm all set, Rod. Again,
Okay.
thanks for the time. I think that the setup is definitely different than I think GameStop back in the day. I know a lot of retail shareholders got into this name much higher, unfortunately. So I think on a lot of fronts, whether it's flow, whether it's factor exposure, whether it's management incompetence, there's a tremendous amount of value that can be unlocked. But I don't even know the catalyst at this point. You've outlined all these different things. Let's hope they come to pass. Let's hope
To me, it's
yeah.
asset sales, right? The asset sales
Right.
have, they only formally announced Honey Burdette in the last quarter, but from my conversations, I'm under the impression that business has been being shopped for longer than that. Lovers has, of course, been for sale. The big issue, of course, is the stupidity of the folks in charge, and their inability to make good decisions. So
Maybe you got some
that is a very
insight
real
into this,
risk.
but did the brand really drop off that much? I think, when I look at retail tracking from, I guess 2022 was a down year. They started some of the divestitures, but I mean, they had a lot of brand heat. They're still, are they growing top line? I thought they were, right? They had to close Lovers. They had to restructure Honey Burdette. Maybe they didn't have the cash runway to support the growth of those businesses because, again, in a perfect world, in a more normalized capital markets environment, Honey Burdette's worth something, probably more than what they're shopping it for right now.
Yeah, look, it's they are a seller They have this large debt burden. They have a very high interest expense. Their interest rate, their weighted average interest rate on the debt is just shy of 10%. So, right now, the document they put out at 4Q, they kind of put out what their pro forma 2022 results would have been like had they not operated the direct-to-consumer website, which we talked about them already signing a term sheet to hand over to take a royalty off of. They also have sold Yandy, which was a money loser. So there's just a lot of noise with also the impairments we talked about. If you look at the trailing financials, that again, this was our intention this is the picture as we see it. We certainly can be wrong on having this viewpoint, but in our view, the idea that the bundle of assets that they own would trade for a $300 million enterprise value is extraordinary, and it's a wonderful opportunity if you're of the view that the price is wrong, and that's what markets are. Public markets give you opportunities if you have a view the price is wrong. But again, there's good reasons that the price is so depressed. The same management team that failed miserably in their direct-to-consumer growth strategy is still at the helm. There's been a couple of good write-ups come out in the last few weeks on the stock where people all kind of coalesce around the same viewpoint that, wow, that's mispriced, but I can't touch it until Cohen is gone. That's what I've heard from a lot of investors, perspective and still in it, unwilling to allocate incremental capital or any capital. So it's a very real risk. He's a stubborn narcissist. I think he's a very sick individual. Unfortunately, narcissists run public companies sometimes. And even though it would be in his own self-interest to resign and see the shares appreciate, I believe, as a byproduct of his exit, clearly this guy still thinks he's the right one for the job, even though, as you saw me share, he noted 2 years ago that if investors felt he wasn't, that he would step aside. So sadly, there's only so much we can do. But as I've noted, with their 3-class board, he is up for re-election this coming year.
Yeah, let's see what we can do. Get the other Cohen guy in.
I'll make a comment on that. Some people were very upset about our usage of the due diligence handle that's currently hosting the chat to kind of publish this new research report. I mentioned our intention is to publish many more in the years to come. We did what I think is the right thing. We reached out to Mr. Cohen months ago, had a conversation with Mr. Cohen months ago, let him know about our intentions, and that's that. I'm not going to go into detail on the discussion, but I will say that I was a little disappointed by how upset some people were about our decision to kind of move forward with the due diligence platform, but we did run it by him.
I will say, and it's nothing unfamiliar to early GameStop investors, right? I remember being banned from Wall Street Bets, first posting about GameStop. Deep effing Value was a laughing stock on there. People thought he was crazy. So this immediate reaction, some people in the retail investor community, largely people that are a bit unhinged, maybe a little too obsessed with certain stocks, maybe not so surprising to us as people that invested in GameStop before it was popular. And Chris R., valued contributor to our community.
Yeah, so before Chris R. chimes in,
I
saw Mr. Shanker put his hand back up, and Mr. Sikwan also came up on the stage. So let's go Mr. Shanker, then Sikwan, then Chris.
Okay, Rod. Quick question. When I see your base and bear case valuations, they're at roughly about $3 a share and $5.50, $5.80 a share. I'm trying to connect that with Risvy's rationale for putting in another $30 million at, what was it, $2.50?
Yep.
Do you see from his perspective, do you think he may have a different valuation in mind for his exit? Because why would somebody put in 30 million at, why would somebody put in 250 at, expecting a probably with all this risk in there, if the upside is, because if I look at the weightings that you put in there, you put like 40% weighting for the bear case and 50% for the base case.
Mhm.
Why would like Risby, or not why would someone like Risby? I'm trying to connect that with the rationale behind Risby putting in $30 million more. See where I'm going with that?
Right, and for sure, I know, I don't know if you heard the whole discussion, but I made the point that the subscription rights offering had just shy of $100 million of indications, and the market cap got down to just about that level, which is quite incredible if you think that all of these people were interested in investing. Now, remember, Mr. Risby did sign. He was made to sign a standstill agreement, so he cannot exceed 30% of shares under himself. So he is subject to that standstill agreement from February. And I agree with where you're going with the question that you would think he would expect more of a return on his $30 million investment at 256 than a $3 exit. I think that it's likely they see more upside than my base case even, but it doesn't really matter what they think at this point. The market is only going to bear what the market's going to bear. I think the asset values, and it's not a great market to be a seller of assets, right? Bed Bath & Beyond tried to have its going concern sales for its operations, and specialty retail was not the flavor of the month, during their bankruptcy proceedings. So I get what you're saying, and I would agree, and I think that is a risk that Mr. Risby and Cohn are so disconnected. Their view is so perhaps different of what they think it's worth than what the market is pricing. But then my question for Mr. Cohn would be, why have you never bought a share on the open market, sir? And regrettably, he's never responded to that question, despite him touting how disconnected the share price was in the fourth quarter earnings call. So it's a good point. Let's go to Sikwan.
Afternoon, gentlemen. And the last time you guys put one of these out, I'm essentially going to quote the Big Short. Michael, anytime you find something, we make money. That being said, I've been following your thesis from the Playboy. I think post was like March. I think a while back. And while I agree with you, like intrinsically, the company was undervalued. And the thing is, I just wanted to point out that about a year but for the last 2 years, we kind of didn't factor in like the macro environment, the prices on falling from like everything from GameStop to Bed Bath & Beyond to Playboy, all essentially going down, essentially making similar, I guess, like stock movements, essentially. But that being said, do you see any more macro headwinds that could keep pushing the price down? And then two, I also want to ask, do you have any bullish cases for like any of their NFT projects, just out of curiosity?
So I'll answer the second one first. No, because Mr. Cohn is an inept operator who couldn't run a lemonade stand. So I would much prefer that they don't do anything more with NFT while he remains at the helm. You're spot on. I said it earlier. I want it to be crystal clear. I'm deeply underwater on my position, but that doesn't inform my perspective on the business. I've been wrong about the business, and while I do think that forward returns are attractive on a risk-adjusted basis, that doesn't necessarily mean I get back to my costs, right? And that, as I really want to drive home, I know people, a lot of retail investors obsess over their cost basis, and that's like the only thing they think or care about, but it's really irrelevant. The market doesn't care what your cost basis is. It shouldn't be the driving decision behind your thinking.
Oh
but
yeah,
for
just to throw this out there to the public. I am in complete agreement with Rod on his thesis with Playboy. It is a severely undervalued company. I just wanted to point out, like last year, we just had different views on the macro environment at that time. That being said, actually, what was I going to? Sorry, I'm having like a brain fart here for a second. That being said, Yeah, that I'm not saying that you were wrong on the undervalue price point of Playboy is essentially what I'm trying to say. But I'm just wanting to know if you have any macro headwinds like in your calculations in terms of like buying it.
Yeah, look, I mean, if if Australian retail continues to be piss poor, well, a prospective buyer of Honey Birdette is mostly buying, a chain of Australian lingerie stores. Yes, there are U.S. stores, and yes, the growth opportunity in the U.S. is nice as the company has sought to kind of position it as. That doesn't change the reality that it's still largely an Australian business. So for the sale of that asset, that's one thing. And the lower end consumer has been challenged domestically. And when I think about Lovers, kind of that sex shop chain, that could be further headwinds to that asset sales proceeds. Broadly, the fact that the Chinese goods consumption has not shown a big impulse upward. There's a lot of unemployment in China, right? Their their contractual minimums going down under the new joint venture agreement, and now, yes, if you're getting a higher percent of take rate, that's great and all, but if you're not selling as much, you may end up with less proceeds. There's certainly real macro risks, across the world impacting their business, and I don't want to downplay those.
And then finally, like I feel like one of the biggest plays of GameStop when you guys did the DD. I know you guys released in January, but before then, I know you released your DD on Wall Street Bets, and there was just like talk of it earlier. And I'll be honest with you, like the month of wait, was it November or December when you guys released? Was it you or somebody released something about GameStop? I was like, what the hell are these guys doing?
I
But
recorded the first ever podcast I did of any sort. December. We recorded it December 12th, I think it was 2020, and it came out a few days after. So that's yeah, I was involved in that. Our report, the GMEDD report, came out about a month later after the Cohen settlement was resolved. I talked a little about that earlier, but
yeah,
um,
the reason why I bring that up is because there was maybe I'm thinking like the Playboy thing as like a trading vehicle also like is there like what kind of like social sentiment or like social catalyst from the retail side like is up and coming essentially that can generate some um I guess like interest in the actual stock for like the retail community because
well, maybe
uh,
people will read the report and that'll interest them. But beyond that, it's a very illiquid security, frankly. I think it traded about 500,000 shares today, which was up a little bit, but as I noted, it was eliminated from the indices. Institutionally, it's kind of too small for most institutions to take much interest, and the challenges for any prospective activist involvement make it less than desirable to maybe step in and try and ruffle feathers. So there, I have no clue what the stock is going to do from a trading perspective, if volume is going to go up or down or price go up or down in the near term. Um, but I would just point out that it is a very illiquid stock, and the average daily trading volume has been less than I think $1 million for most of the last couple of weeks on a daily basis. So it's very illiquid. There's very real risks. There's certainly risk to the downside of our bear case. So I don't want anyone to think that there's any sort of sure thing. But yeah, hopefully that's fair.
all right, thanks guys.
Chris, go ahead, sir.
Oh, hey, how's it going? Yeah, I just had a question. It might be a stupid question, but I remember hearing what you said earlier about if Playboy were to go through an asset sale, right? Let's say they sell the Honeybird business, which you in your model you estimated to be worth 180 million in your base case, or their Lovers business, which is I think you estimated to be 20 million, right? Let's say they sell those two, and you said that the company would then be too small to justify a public listing. But like, my question was that couldn't they just like move to like a smaller cap exchange like Nasdaq Capital Market? Like, do they have to go private if the enterprise value is like only worth a couple hundred million?
I mean, there's absolutely no guarantee that there's a transaction for any of the assets, right? They're for sale. It doesn't mean they sell. You're right. It could end up staying as a publicly traded entity. That's not what we believe transpires. I will note it was clear from my conversation with another investor who spoke with management. The management was quite displeased by the voting results of the proxy. I think they understand how hated and disliked they are. I think they are not interested in seeing the vote come to fruition next year, frankly, with Rizvi and Cohn both up for sale. But who knows what's going to happen.
Thank you.
Did I say up for sale? I meant up for re-election, sorry. I'm just looking at people. Some people have been pinging me in Discord. I have not looked at Twitter, probably for the best. Got one about potential pivot with the quote face of the business. That's a good point. It is a one of a kind brand. The questioner noted, quote, if it continues down its current path, Mark Cuban seems to be someone who potentially fits the Hefner role. Maybe, it is a very libertarian-esque ethos around the brand, as I noted in my tweet. Yesterday they've been a supporter of NORML for kind of cannabis legalization for more than half a century. They've been an advocate for women's rights and abortion rights for half a century plus. A lot of stuff that people don't necessarily realize if they hadn't maybe read some of the articles in Playboy in their youth or been interested in the brand. So I think that there could be if you're a deep-pocketed individual and you see this brand that speaks to you, look, anything could happen, right? But that's certainly not and that's not something we are anticipating happening. But I would acknowledge that that people like to buy showpieces, assets all the time. And if you're a billionaire and you see this, brand get put up for sale, maybe you decide to buy it. Who knows? But yeah. Okay. Folks on the panel, got 10 minutes till the top of the hour. Don't know if there are any other questions from you guys or anyone who's in the audience who wants to ask away. Okay. Look, I've enjoyed this. I hope it's been informational. And look, please do your own due diligence. If this is your first time hearing about the stock, there's a lot more work for you to do. This report is not going to get you all the way there. It's our perspectives based on our work. And we're hoping to be wrong. As I noted, I've been wrong about it, to date in terms of the share price telling me so. I was very wrong about GameStop for many years, and people would be sure to remind me on a regular basis. And now that I'm not long GameStop, people are sure to remind me how upset that makes them. So you can't win some people, but it's okay. The wonderful thing about sharing information, though, is that you can act on it as you see fit. I want to kind of really reiterate the point that I appreciate the folks who've been sharing their crowdsourced research on the creator platform with us. Whether you're talking to creators, whether you're tracking creator ads, you're tracking activity, etc. You know who you are. You're appreciated. Just going back again to why that whole GameStop experience was so special for Joe and I was that a lot of people were sharing their own deep research and insights. If you recall, I started to kind of crowdsource order numbers because I realized you could track their e-commerce activity through their sequential order numbering, and it became a way to inform me that their 2020 holiday sales weren't going to be very good. And unfortunately, in a in the stock market, when you make short-term trades and decisions, you can be right and you can be wrong. And even though the results were poor because of the crowdsourced research, there was a settlement that same day. So that kind of overrode the fundamental reality. So crazy things can happen in markets. We've seen it over the last 3+ years. They're going to probably continue happening in markets. But we hope that you appreciate this was our effort to try and paint what we see as the best kind of perspective picture for PLBY going forward. And as I alluded to, I'm very likely going to be opposing Mr. Cohn's board seat come this year's AGM. So we need to formalize that and finalize all of that. I don't want to say that's a certainty, but assuming that he does not resign and that he isn't fired by then, I think it's the right thing to do. So we'll see how everything goes. But look, thank you everybody for your interest in our PLBY DD research, for your interest in our due diligence investor community. Joe, maybe share a little bit about some of the different programming that we do, that we're going to keep doing, and about the community.
Yeah, so this isn't our first Twitter space. We've been hosting spaces for months now over on the Wook Capital Twitter account. We do plan on moving over some of the broadcasting over here, hopefully have the bigger audience that's followed this account for years now. But tune in to Rod's open mic, should be the next broadcast. It'll be on Wednesday. So that'll be
book club.
Oh, and the book club. We do a book club as well. So check that out. Go to the @Wook Capital. You'll see some of that programming. It's gonna, slowly come over here, but for now, we're gonna keep it on that account. So tune in, book club and the open mic.
Yes, so just to expound on that, Howard Marks, Mastering the Market Cycle. If you are interested, we'll be having a discussion tomorrow night at 8 Eastern for 2 hours on that book. So it's 25 hours from now. As somebody's pinging me, book club. What nerds read? I know we're very nerdy, but our objective is to become better investors over the years. And I think that kind of reading good literature and having discussions about the takeaways from that is one way to become better as an investor. So there's the book club. Joe mentioned the open mics I host on my personal account Wednesdays at 7. Kind of touch along a bunch of different market topics. I see some folks listening who participate regularly and are appreciated for that. And then we do our our Wook in review on Fridays at the close, heading into the weekend. So we'll be doing all of those this week as well. And yeah, we hope, again, appreciate your time and your interest in our work. And we look forward to the next report that we put out and we can have this dialogue on. So thank you again, everybody. And cheers.